A world transformed, the post-war boom. The world of 1873 seemed poised for continued prosperity. The American Civil War and the Franco-Prussian War had concluded. These conflicts spurred technological advancements. Industries boomed, fueled by innovation and expanding markets. Railroads crisscrossed continents, connecting distant communities. Factories churned out goods at an unprecedented pace. The Second Industrial Revolution was in full swing. New technologies like the Bessemer process revolutionized steel production. This made possible the construction of larger buildings, bridges, and railways. The telegraph connected people across vast distances, facilitating rapid communication and trade. A sense of optimism permeated the air, and fortunes were being made. Europe and America experienced rapid economic growth. The unification of Germany in 1871 created a new economic powerhouse. The United States, recovering from the Civil War, saw its industrial capacity expand dramatically. International trade flourished, connecting nations and fostering interdependence. Capital flowed freely across borders, fueling investment and growth. This period of post-war prosperity seemed unstoppable. New inventions and technologies promised a future of abundance. Investors eagerly poured money into new ventures, confident of high returns. Governments encouraged economic expansion, often through lax regulations and easy credit. The stage was set for a dramatic reversal of fortune. The seeds of crisis speculation and credit expansion. The rapid economic growth of the post-war era was fueled by an explosion of credit and speculation. Investors eager to capitalize on the booming economy borrowed heavily to finance new ventures. Banks, flush with cash, readily extended loans, often with little regard for risk. This created a bubble in asset prices, particularly in railroads, real estate, and mining. In Germany, the influx of French war reparations after the Franco-Prussian War led to a period of rapid industrialization and financial speculation known as the Gründerzeit. New companies sprang up overnight, often based on flimsy business plans. Stock prices soared, driven by speculative frenzy rather than sound fundamentals. The same pattern played out in the United States, where railroad construction boomed, financed by massive borrowing. The easy availability of credit masked underlying economic weaknesses. Many of the new ventures were poorly managed and unprofitable. The rapid expansion of production capacity led to oversupply in some industries. As competition intensified, profit margins began to shrink. The foundations of the economic boom were becoming increasingly shaky. The speculative bubble couldn't last forever. As asset prices became increasingly detached from reality, a correction was inevitable. The first cracks began to appear in Vienna, the capital of the Austro-Hungarian Empire. A speculative frenzy in the Viennese stock market, fueled by easy credit, was about to come crashing down. The Vienna crash, the spark that ignited the blaze. The Vienna Stock Exchange crash of 1873, also known as the Wiener Krach, marked the beginning of the global financial crisis. The speculative bubble in Vienna had reached its peak. Stock prices were grossly inflated, driven by excessive borrowing and unrealistic expectations. The collapse of the Vienna Stock Exchange on May 9, 1873, sent shockwaves throughout the European financial system. The failure of the Kreditanstalt, one of Austria's largest banks, triggered a domino effect. The bank had invested heavily in speculative ventures, and its collapse exposed the fragility of the financial system. Panic spread quickly as investors rushed to sell their holdings. Stock prices plummeted, and businesses went bankrupt. The crisis quickly spread from Vienna to other European financial centers, including Berlin and Frankfurt. German banks, heavily invested in Austrian ventures, suffered significant losses. The German stock market plunged, wiping out fortunes and triggering a wave of bankruptcies. The interconnectedness of the global financial system meant that the crisis could not be contained. News of the crash reached the United States, where it exacerbated existing economic weaknesses. The American economy had been experiencing a period of rapid growth, fueled by railroad construction and industrial expansion. However, this growth had been financed by massive borrowing, and the American financial system was vulnerable to shocks. Panic on Wall Street, the American contagion. The news of the Vienna crash reached New York in September 1873, triggering a panic on Wall Street. The failure of Jay Cooke & Company sparked a wave of selling on the New York Stock Exchange. Stock prices plummeted and businesses began to fail. The panic quickly spread throughout the American financial system. Banks began to call in loans, leading to bankruptcies. Unemployment soared, marking the start of the Long Depression. Section 5. The Long Depression, a global economic chill. The Panic of 1873 ushered in a period of prolonged economic stagnation known as the Long Depression. This period, lasting from 1873 to 1879 in the United States and impacting various countries differently, was characterized by deflation, declining industrial output, and high unemployment. The interconnectedness of the global economy meant that the crisis spread rapidly from country to country. Deflation, a sustained decline in the general price level, became a defining feature of the Long Depression. Falling prices, while seemingly beneficial, discouraged investment and consumption. Businesses postponed investments as they expected prices to fall further. Consumers delayed purchases hoping for better deals in the future. This downward spiral further depressed economic activity. The Long Depression had a profound impact on industries across the globe. Manufacturing output declined sharply as demand for goods fell. The railroad industry, which had been a key driver of growth in the pre-crash years, suffered a severe contraction. Mining and agriculture also experienced significant declines. The global nature of trade meant that the economic downturn spread rapidly. Unemployment soared during the Long Depression, causing widespread hardship. Workers lost their jobs as businesses closed or reduced their workforce. Families struggled to make ends meet, and poverty increased. The Long Depression had a lasting impact on social and political landscapes, leading to unrest and calls for reform. Section 6. Social upheaval, the human cost of the crash. The Long Depression had a devastating impact on working-class families and communities. Unemployment soared, leaving millions without a source of income. Poverty and hunger became widespread, especially in urban areas where industrial workers were concentrated. The social safety net was minimal, leaving many families to fend for themselves. The economic hardship led to widespread social unrest. Workers, desperate for relief, organized strikes and protests. Labor unions gained strength, demanding better wages and working conditions. The government responded with a mix of repression and reform, attempting to maintain order while addressing the underlying causes of the unrest. The Long Depression also had a profound impact on immigration patterns. As economic opportunities dwindled in the United States and other industrialized nations, immigration slowed. Nativist sentiment increased, as some blamed immigrants for the economic downturn. Governments began to implement stricter immigration policies, restricting the flow of people across borders. The economic crisis exposed the inadequacies of existing welfare systems. Charities and private organizations struggled to meet the growing needs of the poor. Governments began to experiment with new forms of social welfare, including unemployment insurance and public works programs. The Long Depression marked a turning point in the development of the modern welfare state. Section 7. The Agricultural Depression. Farms and fields falter. The Long Depression significantly impacted agriculture. Falling prices and increased competition squeezed farmers' incomes. Many faced debt and foreclosures. Rural communities suffered economic decline. Farmers migrated to cities, worsening urban unemployment. Farmers demanded government intervention. Section 8. Political aftershocks, shifting sands of power. The Long Depression had profound political consequences. The economic crisis eroded public confidence in existing governments and political parties. Voters, frustrated by the economic hardship, turned to new political movements that promised change. The rise of socialist and populist parties reflected the growing discontent with the status quo. In the United States, the Greenback Party emerged as a political force, advocating for inflationary monetary policies to ease the debt burden of farmers and workers. The Greenbackers challenged the dominance of the established Republican and Democratic parties, reflecting the growing dissatisfaction with the government's response to the economic crisis. The political landscape was undergoing a significant transformation. In Europe, the Long Depression fueled the growth of socialist and labor movements. Workers facing unemployment and declining living standards organized to demand better working conditions and greater economic equality. Socialist parties gained support, challenging the established political order. The seeds of future political and social change were being sown. The Long Depression also contributed to rising international tensions. As economies contracted, governments adopted protectionist policies, raising tariffs and restricting trade. These policies exacerbated international economic competition and contributed to a climate of distrust among nations. The economic crisis had far-reaching political and geopolitical implications.